Essentially what we tried to do here was construct efficient frontiers, one for the Islamic portfolio and the other for the conventional portfolio, and simply compare them visually. Now, if we can establish that the conventional efficient frontier is located northwest, as you will see later on in one of the slides that I'll show you later on, then we consider this as tentative evidence of inferior portfolio diversification for the Islamic portfolio. In coming up with these efficient frontiers, just a very quick note, we also self-constructed some indices other than working with the Dow Jones sector indices. And the reason why we decided to do this was because when you look at the established sector indices that we have, they don't quite fit nicely into that dichotomy between Sharia compliant and non-Sharia compliant. As a simple example, suppose you look at the case of the real estate sector. In Malaysia, we have a number of firms in real estate which are Sharia compliant, and there are also a number of real estate firms which are not Sharia compliant. So when we have a sector like real estate, how do we classify this? Is it Sharia compliant or not? So to address this, we constructed our own, without going into details, but that's essentially what we did. The next method is time-varying maximum Sharpe ratio. The intention here is to essentially track how, or basically what we did was we computed on a quarterly basis what was the maximum Sharpe ratio that you can obtain for an Islamic portfolio versus a conventional portfolio. And then we track that across time on a quarterly basis. This allows us to analyze some time-varying behavior of what we're trying to study. The third method is your multivariate gauge, and we computed the dynamic conditional correlation. Again, without going into details, the objective of using this method is to go into more details on the interaction between Sharia compliant and non-Sharia compliant sectors. The basic idea here is that if we do find a low degrees of correlation between non-Sharia compliant and Sharia compliant, that's, again, some tentative evidence that there is perhaps some potential loss of diversification benefit. Given as a Muslim investor, I'm not able to invest in, say, finance stocks. If the correlation between finance stocks and your other Sharia compliant stocks is low, then that's somewhat evidence to say that there's some potential loss of diversification benefit. The fourth and final method is we computed the residual variance as a measure of unsystematic risk, which in turn is meant to capture the level of portfolio diversification. And through analysis of covariance, we try to articulate how the differences in the level of diversification, Islamic versus conventional, how it actually affects risk-adjusted returns. We measure risk-adjusted returns using the common performance measurements, such as Jensen's alpha, Sharpe ratio, Traynor, and so on. Okay, we'll jump straight into the findings of this paper. Now here, with the efficient frontiers, there are three graphs here. This first one here, we can clearly see the light blue is actually the conventional portfolio, and the darker blue is the Islamic efficient frontier. So here we can clearly see that the conventional one is clearly superior. It's clearly northwest, right? This is expected return and standard deviation. So for a given level of expected return, the standard deviation of the conventional is lower, right? And when we go into more details, it's not reported here, but if we go into more details, this is mainly attributable to mainly two sectors, which is alcohol and tobacco. Right? These are the ones that are, causing this superior performance of the conventional efficient frontier. Now, interestingly, when you look at panel B here, before that, in this scenario, we allow short selling. So in this second panel, in this second scenario, we impose a restriction in the forming of the efficient frontier to not allow short selling. And when this is the case, we actually find that the efficient frontiers are much closer together, right? Although, if you observe here, there's this part where you could argue that the conventional portfolio is somewhat offering additional options to the investor, namely in the, the lower volatility end of the volatility spectrum. And again, going into details, this is again due to mainly two sectors, the alcohol and tobacco. Now, in this bottom panel here, what we've done is we have imposed for the construction of those efficient frontiers, minimum weights for the sectors that we have. And the reason why we do this is because this scenario makes it more realistic and practical and reflective of real-world conditions. Because, you would argue that a portfolio would only be called a conventional portfolio if it actually contains, non-Sharia compliant sectors in them, right? And the problem with efficient frontiers is that, for instance, here, you could find that the reason why we have such a superior frontier here is because they have overweighted on, alcohol and tobacco, right? So to remove that kind of effect, we did this. And interestingly, when we did it, we actually find that the Islamic frontier is actually on top of the conventional one. Right? And we argue that this is because there are some non-Sharia compliant sectors which are less efficient, hence pulling down the entire efficient frontier. Okay, there are other things that we did in this paper, but again, in the interest of time, I'll just skip through this. The second set of results relate to your maximum Sharpe ratio. And again, we have the similar kind of scenarios where with short selling and without short selling. And again, the results are very similar. With short selling, you do find that the conventional portfolio is superior. When we put the restriction of no short selling, we find that the differences are much smaller, although we do find that in some cases, the conventional maximum Sharpe ratio exceeds that of the Islamic one. And similar as in the case of your efficient frontiers, when we put the restriction of having minimum weights on all the sectors, we find again the two sets of portfolios come much closer together, just as in the case of the efficient frontiers.
5 minutes to go.
Okay. What we did here was to construct your global minimum variance portfolio and your 1/n portfolio, which are common portfolio strategies for many investors out there. And interestingly, the point is when you have low volatilities, you do find that the conventional portfolio does have the upper hand as compared to the 1/n portfolio. I'll skip this. Okay, the main thing from the analysis of covariance is that, number one, level of diversification does matter. Our results show that. However, it's not the only factor which is driving performance. The levels of diversification between Islamic and conventional funds are not statistically different. And finally, the numbers from the previous slide actually show this, that diversification impacts Islamic and conventional funds not very differently. So the conclusion, again, I'm trying to make it simple here because we don't have much time to go into details, but essentially what our results show is that if there are any differences between differences in performance between Islamic and conventional funds, it's unlikely to be caused by level of portfolio diversification. It's due to other things, right? Could be the competency of the asset manager, for example. All right, I'll just go straight into the overall conclusion of this paper. So based on what we've done here, we believe that we have substantial empirical evidence to reject the claim that Islamic portfolios are invariably at a disadvantage. So the point that we are trying to say here is that you cannot make a claim that conventional portfolios will always outdo Islamic ones, right? There are circumstances, there are situations, there are under certain circumstances where the performances will go together, they are closely matched, or even the Islamic portfolios outdoing the conventional portfolios. And as a final note, the situation where we do observe the conventional portfolios outperforming the Islamic ones, firstly, when short selling is allowed. Secondly, when we are looking at low volatility portfolios, when the investment horizon is relatively shorter, and when we allow overweighting on particular sectors. How many minutes do I have? Almost done? 2 minutes, okay. So some implications of our results. We believe that this is a contribution to promote Islamic equity markets. So non-Muslim investors can have some assurance that they may not necessarily suffer a financial cost when they're investing in Islamic equities. That's one. And if you do want to invest in Islamic equities and you want to minimize your so-called diversification disadvantage, these are the things that you may want to consider. Invest in mid-range to higher risk portfolios. Invest in longer investment periods. Try to search for a substitute for tobacco sector, because this is the sector which is giving the upper hand to the conventional sector. And finally, perhaps the disadvantage is somewhat lesser when you are working with markets that don't allow or limit short selling activities. Okay, so I think I'm out of time, so thank you very much.
Thank you, Dr. Nazrul, for sticking to the time of the presentation. I will invite Dr. Chi Dong to discuss the paper in 7 minutes, please.
Good afternoon, everyone. It's my honor to discuss this paper here. This paper actually asks a very interesting question. Is there a diversification cost of Sharia compliance? Muslim investors face Sharia compliance. The Sharia compliance imposes restriction on portfolio buildings. Certain assets are non-Sharia compliant. For example, companies that do business in gambling, tobacco, so you wouldn't invest in stocks related in those sectors. So immediately, the Muslim investors face a strong constraint. My first look into this question would be, if I have such a big constraint, then I would imagine that the Islamic portfolios are going to underperform conventional unconstrained portfolios, probably with a large magnitude. But what the author find is that, well, it's not the case. The efficient frontier of Islamic portfolios is very close to that of conventional portfolios. The author also looks into the determinants of the magnitude of the difference. He finds that it depends on investment horizon, short selling, and market conditions. How do we connect all these empirical findings together? We may need a theory or some insights into the data generating process. Let's look at a very simple mean variance optimization with Sharia compliance. We want to pick a portfolio that minimizes the volatility with the constraint that we can achieve the target expected return, RP here. And let's suppose this portfolio is a unit cost portfolio where we only invest $1. The new thing here is the Sharia compliance constraint. Let's say asset I is a non-Sharia compliant asset. Then we are going to invest $0 on it. So the question is, will this constraint be binding? And what determines if it is binding? Well, then we could look at the shadow price of this constraint. If the shadow price is positive, then I might have an incentive to increase my weight from 0 to a positive number because it further reduces the volatility of my portfolio. If the shadow price is 0, then I do not have any incentive to change my weight from 0 to any other number. So the mathematical result will be, well, for the Sharia compliance to be non-binding, this equation has to hold. It's a summation of 4 terms, and it's determined by the variance-covariance matrix, the expected return vector, and our target return. If it's a random vector or random matrix, we wouldn't think that this equation is going to hold. The fact that we find Sharia compliance constraint is not binding suggests that there are some delicate structure in our expected return vector and the variance covariance matrix. I'm going to provide 3 sufficient conditions for Sharia compliance constraint to be non-binding so that conventional portfolio will not be different from Islamic portfolios. The first situation is very intuitive and very simple. If the asset that we are going to throw away has a very high idiosyncratic risk and a finite return, because this asset has a high idiosyncratic volatility, it's not going to be hedged away, and it cannot be diversified away if we have a very small number of assets. So in that case, I'll just go ahead and throw that asset. If this asset happens to be Sharia, non-Sharia compliant, then...
Dr. Chi, 2 minutes left, please.
How many minutes?
2 minutes.
Okay. If this asset happened to be non-Sharia compliant, then the Sharia compliance will not pose any restriction at all. So the second and the third cases are where the asset is redundant or somewhat redundant. If it's redundant, then I can replicate it perfectly. So I'll throw it. It doesn't matter if I throw it away. If it's redundant but not precisely redundant, then we have a situation where APT holds. If the APT holds, the asset returns follow a factor structure, and no arbitrage opportunity exists. If that happens, one asset is going to be highly correlated with other assets because they share joint factors. But it's not going to be perfectly replaced by a mimicking portfolio because the mimicking portfolio do not provide a diversification benefit. My original asset has a idiosyncratic part that is independent from other assets. Now you are giving me a mimicking portfolio where the idiosyncratic part is not independent from other assets. So I should have lose some diversification benefit. But if we assume that the number of assets is huge, it doesn't really matter. Although I lose diversification benefit, it still can be compensated by the fact that I have a lot of assets to diversify away the idiosyncratic risk. So in short, let me summarize. A risk-averse Sharia-compliant investor in Malaysian equity market is not at a big disadvantage. This result suggests that the Sharia compliance constraint is not binding. Why it's not binding? Because there are special structure of the covariance matrix and expected return. Multi-factor model could lead to this result. So this paper has other empirical findings. I would suggest that he looks into more the data generation process to capture all other empirical findings. Thank you.
Thank you, Dr. Chi. So let's take 3 questions from the audience, please. Yeah, we have one over there.
Very interesting paper. I really have enjoyed the presentation. Couple of things. When I was looking at Efficient Frontier, I got a little bit confused. What I see, I may be wrong with that, it seems that you have created Efficient Frontier portfolio with mutual funds. So if you have created that with equities, but portfolio itself, even those are portfolio. So it seems that you are basically working, you're creating your efficient portfolio using an approach called fund approach. So there was something like when I was looking at the efficient frontier, and I was kind of a bit confused, like how you're suggesting that there is no difference, and when I look at the efficient frontier, they were telling me a very different story. So that was number one. And number two, you have allowed short selling in one of the portfolio where the major, we can see a major difference in performance. So, but short selling is not allowed for Islamic investors. So, what benefit like are you trying to convey by showing this efficient frontier? Please, thank you.
My apologies because I guess I was rushing through the presentation. I didn't have time to clearly identify the data that I was using. For the first 3 methods that I was working with, I actually work with sector indices, as I mentioned. And in fact, I use 2 sets of indices. One is Dow Jones and the other is my own self-constructed one. So it's not mutual funds. It's only for the last analysis of covariance that I actually worked with actual mutual fund return data. So maybe that can clarify. And on the second issue of short selling, you're right. Although it's still a debate because in Malaysia we actually do allow short selling. The Sharia Advisory Council of the Securities Commission of Malaysia issued their fatwa to say that short selling is allowed. I know it's a big controversy, and most parts of the world short selling is not allowed by the majority of scholars. But in the case of Malaysia, they do. I don't agree, but that's their decision. So, but I take your point. I guess the reason I included is just to add additional dimension to the whole analysis. But thank you for that comment.
Any other questions? Yes.
Yeah, more of a comment, I should say, a couple of comments. Here I am. Very interesting paper, and I also enjoyed your talk. I know you were time constrained, but one thing also in line with what's currently, I think, very interesting in the conventional literature would be, one, the way you construct a mean variance portfolio, of course assumes, also given your linear assumption about the dependent structure of the various assets, that basically in mean variance, you have the underlying variables conforming to a normal marginal density. Now, there's also been some papers recently over the last few years that would look at diversification in the tail. In other words, what happens to your portfolio if you look at the distributional properties of the underlying assets in your portfolio, and whether that would change your efficiency frontier. What people have found is that what generates a mean variance optimizing portfolio, assuming that variables converge to a normal distribution, mightn't necessarily generate a perfectly diversified portfolio for extreme tail shocks. So one thing I would encourage you to do is possibly explore, not necessarily in this paper, but in a sequel maybe, to look at the tail diversification properties of a conventional and a Sharia compliant portfolio. The second suggestion I would have is also maybe open your mind to the possibility that diversification is frequency dependent. In other words, the horizon of your investment holding might determine the degree of diversification you can achieve. And what I mean by this is basically decomposing your time series into the frequency spectrum via wavelets, for instance. So it might just be the case that your Sharia portfolio is inferior in from the perspective of diversification under normal times over daily observations, but over 5 months, for instance, that portfolio might be superior by conditioning on the frequency, the length of holding that investment. So these were just 2 comments, and I was just intrigued by your presentation. Thank you very much.
Thank you for that suggestions.
Thank you very much. Our next paper is Social Norms and Market Segmentation, the Effects of Religious Beliefs and Stock Market Returns, Liquidity and Liquidity Risk. I'll invite Dr. Abdullah Al-Awadi to present the paper in 20 minutes.
Okay. Good afternoon, everybody. My name is Abdullah Al-Awadi, and I would like to present this paper on behalf of myself and the other co-authors. The title is Social Norms and Market Segmentation, the Effects of Religious Belief on Stock Markets Outcomes. First of all, I'm not a doctor. I'm a PhD student. Hopefully, I'll be a doctor soon. Here's the content of my presentation, where I'm going to start by introduction, going through the presentation, and then I'll talk about literature, questions, until results and conclusion. So let me start with an introduction. Culture has many components, where religion can be a central component of some cultures and may influence investors' behavior and stock market outcomes. A good example would be in Islamic societies. Investors may prefer to trade Islamic stocks and neglect non-Islamic stocks, and this behavior may have an economic consequences on stock markets, which could be quite similar to the Western societies when investors decide to trade socially responsible stocks and neglect sin stocks. So what I'm trying to do in this research, we are examining the influence of religious beliefs as a key component of culture on stock market outcomes, and whether religious beliefs can create market segmentation leading to differences between Islamic and non-Islamic stocks, returns, liquidity, and liquidity risk. Why we are readdressing issues about market segmentation in an Islamic context? We believe that Islamic context may provide more clear data, since in Islamic context, we have a clear rule that prohibits Islamic trader from trading non-Islamic stocks, and they view non-Islamic stocks as norm-conflicting stocks, since they conflict with their Islamic norms. The other reason is that it's much more easier to identify Islamic and non-Islamic stocks in our data. We use the data from GCC stock markets, where we can define Islamic stock based on the company article of association. So we can say this stock is Islamic if the company is following Islamic trading rules and have a Sharia committee to make sure that all the operations of the firm follow Islamic rules. So what the literature suggests about these issues. Some societies, such as Western societies, as I said before, they have definitions for norm-conflicting and norm-conforming stocks. They may include political, environmental, equality of women, anti-nuclear issues, and human rights. Other societies, such as religious societies in the Islamic world, they define non-conforming and non-conflicting stocks based on Islamic rules. What we expect the return of Islamic and non-Islamic stocks? We may expect that non-Islamic stocks to outperform the market as long as they are neglected and not traded by investors. We may expect them to compensate investors for limited risk sharing, as Robert Merton suggested. What about the return of Islamic stocks? In contrast, we may expect that the return of Islamic stocks to be lower or match the market. As if we construct an Islamic portfolio, we're going to neglect the outperforming non-Islamic stocks, so we're going to face diversification cost. The other reason could be that if we are going to buy an Islamic stocks, these stocks we may expect them to be more preferred by Islamic traders and have an excess demand and be overpriced in the markets. What about the liquidity and liquidity risk? We may expect that non-Islamic stocks, as long as they are neglected, they may have lower investor base. Lower investor base means lower liquidity. Lower liquidity means means these stocks will face higher future liquidity risk. So what is the issues in the literature? The literature examined the influence of investors' behavior on market segmentation. However, literature suffers from some issues. Most of the studies have been conducted in Western societies. There was no common definition for non-conflicting stocks, sin stocks, where there was many definitions, and these definitions led to inconsistent results in previous studies. Also, there is no current understanding of the influence of religious beliefs and social norms on stock market liquidity and liquidity risk. We propose this question: do religious beliefs as social norms proxy affect stock returns, liquidity, and liquidity risk? To answer this question, we're going to test several hypotheses, starting from the first hypothesis. Non-Islamic stocks, as they are neglected, they should compensate investors for limited risk sharing and outperform the market. Islamic stocks, as they are preferred by investors to be traded, they should have higher liquidity. Islamic stocks, we expected that they have higher liquidity, they should have lower liquidity risk based on the literature. So research data. These are the leading countries in the Islamic financial industry based on 2013 report of the Global Islamic Finance Report, where Iran is the biggest country, then Saudi Arabia, Malaysia. However, in our data, we excluded 2 countries from the leading countries in Islamic financial industry. We excluded Malaysia and Iran. We excluded Iran because it has a different structure for stock market, and we cannot compare between Islamic and non-Islamic stocks in Iran stock market. And we excluded Malaysia, as in our study we are interested in examining the influence of investors' behavior, Muslim investors' behavior on stock market outcomes. We include the countries with high percentage of Muslims and excluded Malaysia as it has much lower percentage of Muslims. And the other reason that in these countries, the 5 countries, we have more clear definition of Islamic stocks than Malaysia. Malaysia, they use a screening strategy to define Islamic and non-Islamic stocks. In these countries, we can define Islamic stocks based on the articles of association for the company to find out whether the company operates within Islamic rules or not, and whether they have an Islamic Sharia committee or not. The data achieved from Reuters and Bloomberg, 2004-2014, daily stock prices and trading volume, and we have monthly data also. We use them as control variables. Our research methodology, we run cross-sectional tests, where the first cross-sectional test to test the difference in returns between Islamic and non-Islamic stocks. We use a dependent variable excess return, and in the independent variables, we included the dummy variable that equals 1 if the stock is Islamic and controlling for firm-specific factors. We tested the liquidity and liquidity differences. We used 5 liquidity proxies, from the simple ones to more sophisticated for daily data, where we used log of the volume, log of the amount volume traded, and turnover ratio, Amihud's liquidity ratio, and the adjusted form of Amihud's liquidity ratio, the log 1, to minimize the influence of outliers. Then we run cross-sectional tests, where the dependent variable is the liquidity proxies, and similar to the previous regression, controlling for firm-specific factors, including dummy variable that's equal to 1 if the stock is Islamic. To test the liquidity risk differences, we used Achari and Pedersen liquidity risk proxies, where firstly we calculate the innovation of a liquidity, since liquidity is highly persistent and autocorrelated. Then we calculate the liquidity risk betas, where Amihud's model, Achari and Pedersen model, contains 3 liquidity risk dimensions: commonality in illiquidity, commonality of the stock illiquidity with the market illiquidity, and return sensitivity to market illiquidity. investors prefer stocks that gives higher return during a liquidity period. And the third, liquidity risk proxy, which is liquidity sensitivity to market return. Investors prefer liquid stocks during financial crisis and bad return periods. Then we run cross-sectional regression, where the dependent variable is the liquidity proxies and controlling for firm-specific factors. Firstly, in our analysis, we did a preliminary analysis where we did a median equality test between the returns of Islamic and non-Islamic stocks. There was no significant difference in contrast to our hypothesis. However, when we tested the median equality test for the liquidity proxies, we find that there is a significant difference supporting our hypothesis that Islamic stocks are more liquid in these markets. The results of the regression, I excluded the tables to make it more interesting. Supporting our hypothesis, non-Islamic stocks significantly outperform Islamic stocks in Kuwait and Qatar, 2 markets, and in contrast to our hypothesis in the 3 markets, they didn't outperform. The second hypothesis, Islamic stocks are more liquid than non-Islamic stocks. Supporting our hypothesis, Islamic stocks are more liquid in terms of trading volume and value in all of the markets in our data. And in terms of market impact, Islamic stocks are more liquid in Kuwait, Qatar, and Saudi Arabia. In general, all significant liquidity proxies suggested that Islamic stocks are more liquid than non-Islamic stocks. The results of testing hypothesis 3, Islamic stocks expected to be have less liquidity risk than non-Islamic stocks. So, in terms of commonality in illiquidity, Islamic stocks have less commonality in illiquidity, means less liquidity risk. In terms of return sensitivity to market liquidity, Islamic stocks and non-Islamic stocks, we found mixed results. In terms of liquidity sensitivity to market return, which is the third liquidity risk proxy, Islamic stocks have higher. So to have a final conclusion, we followed previous studies by calculating the net of the liquidity risk dimensions, the net effect. The net effect suggests that in all these stock markets, Islamic stocks, supporting our hypothesis, Islamic stocks have less liquidity risk caused by the most influential liquidity risk factor in these markets, which is commonality in liquidity. So, discussion and contribution. The conclusion of this study is that investors neglect non-Islamic stocks, create market segmentation, leading non-Islamic stocks to be less liquid than Islamic stocks. Non-Islamic stocks have higher liquidity risk than Islamic stocks, and non-Islamic stocks have higher return in 2 markets out of the 5 markets, Kuwait and Qatar. In this study, we extended the previous literature by examining the influence of religious beliefs on stock market liquidity and liquidity risk, and readdressing issues in market segmentation while minimizing the identification problem, since we easily identified Islamic and non-Islamic stocks, and there is more clear definition in our data. We highly suggest that regulators, firms, and traders consider market segmentation, especially for regulators trying to change the regulation of these markets to keep them more competitive in the global world. Thank you very much.
Thank you, Mr. Abdullah Al-Awadi. Mr. Mansour Ibrahim will discuss the paper. You have 7 minutes. Okay.
Okay, Assalamu alaikum and good afternoon to all of you. And first, let me thank the organizer for having me here. And very privileged to discuss, I think, very interesting work that has been done by Abdullah and Michael and Vijaya. Very straightforward articles and gave very important insight at the end. And synopsis little bit or summary little bit of the work that has been done. Very explicit or objective, try to look at the influences of social norms and basically classifying the stock into norm-conforming and norm-conflicting stocks, and try to look at the return, liquidity, and liquidity risk of those two classes of stocks. And the basis that has been used for stock classifications, use religion-based classifications, is basically Islamic and non-Islamic stock are identified as norm-conforming and norm-conflicting stocks, respectively. And this is further backed by the use of the GCC markets. And from what has been explained, there's basically GCC offers unambiguous religious guidance to classify the stocks, and the level of religiosity is higher. And I think these are the key in terms of the assumption that has been made that drive the hypothesis, which is basically the majority of investors in this market will invest only in non-conforming stocks, and majority of investors, of course, will be basically on non-conflicting stock will be neglected. And as a result, liquidity will be higher for Islamic stocks, and liquidity risk will be less. And with that, the presence of liquidity risk of non-conflicting stocks, then the expected return of non-conflicting stock will be higher. And that's the hypothesis. And the finding is basically more or less support what has been stated in the hypothesis. No different in return except for the two markets, and then non-conforming stock have higher liquidity, and non-conforming stock have lower liquidity risk. Right? I have very simple observations which mostly call for more explanations in the context of the basis of classifications. Okay. And in terms of sample that has been used, sorry. Okay. And more discussion on certain point. Right? Now, as I mentioned, the basis for classification is the use of GCC market, and argue that investors in GCC market will behave religiously and invest only in non-conforming stocks. I'm not sure whether that classification can be at least acceptable. I think more argument should be put forward. Right? Now, when we look at, for example, the work by Rahman and Askari 2010, how Islamic countries, I think most Islamic countries do not fare well in the context of Islamicity index, right? And we may argue that this index may reflect the institutional level, the government level, but then if you go to the trust dimensions of social capital index, again, OIC countries do not fare well, right? So basically, some evidence must be put forward that these Muslim investors behave religiously and just invest in norm-conforming stocks. And I think the better evidence may be try to look at the world value survey, try to look at various dimensions of religiosity, right? Cognitions, affections, as well as actions. Whether investors in these regions, they feel religiously, or they act religiously, or they think religiously. That one may be a better way of identifications, right? And one more thing that I would like to know in terms of investors in GCC market, I do not know much. What are the percentage of institutional investors and individual investors in this market? The reasons in the hypothesis developments, I think the example of KFH has been given, why the Muslim investors will only invest in norm-conforming stocks, but when it comes to the discussion results, then the justification for the differences have been given due to the individual investors. So it's kind of a little bit conflicting there. And I may relate to the article that's supposed to be presented yesterday on
2 minutes.
For the case of Turkey, that the way that people behave may also depends on the size of investments. A very important part, right? So if we know the percentage of institutional investors and individual investors, maybe more story can be told. Right? So those are things that I look at, I think, more explanations. And the second part, I think the sample, I face a problem with the sample that has been used, right? Because the result may be driven by the sample, because when you look at the majority of Islamic stock in the sample are stock of financial institutions. For example, the case of Bahrain, Qatar, and Dubai, all the stocks are related to financial firms. 100% Bahrain, Qatar 100%, and Dubai 83%. All those are financial firms, but for conventional or non-Islamic stocks, majority of them in non-financial firms, right? And I think few of the work that has been done, one of which Forrester and SAPS, basically industry composition of portfolios have important bearing, especially when financial firms are included or excluded from the samples. Now you have very unbalanced in terms of the samples, compositions of the stock itself. And I think the result interesting in the sense that investments in non-conflicting stock not compensated for liquidity risk. What are the reasons, right? I think the author can bring some theoretical foundations, perhaps can bring in religiosity and link to corporate decision making. One of the papers, the previous section discussed on these things. They're quite interesting. And in context of looking at the performance of the firms as reflected by stock market. And minor point in terms of elaboration methods, I'm not sure whether cross-sectional regressions or panel regression, and panel regressions, I suppose that use least square, but how heterogeneity has been controlled for, so there are various things that need to be taken care of. And these are some of the observations I make, but very interesting work, and I learned a lot of things from here. Thank you.
Thank you. Let me open the floor for the questions from the audience. No questions. All right. So let us go for a break. We will resume at 3:30 p.m. Thank you all.
Islamic finance literature, and basically how to bring those two together and to get, hopefully at some point, get Islamic finance, banking and finance papers published in the top journals. This has not happened to date. Professor Allen says that the Review of Finance has one forthcoming. That will be one of the very first in the top journal that we know of. But the data, the institutions, the issues of Islamic finance are so rich that there should be a way to publish. And that's the idea of the editors panel here, is to bring those issues together and to see how we can go far. What I need to say right up to the top is this is not, we're not inviting, if you got on the conference here, you're going to get on the journals. If those of us who've done this a lot of times, I'm very happy to say I've been rejected by all the best journals, and the acceptance rate at the journals that you see up here is extremely low. So not to raise false hopes, but it can be done. People do publish all the time, and it is very nice when you publish in any of these journals here. I've been fortunate a few times, but you never get tired of it. And the first one is always the sweetest. So that's the idea of this conference, and the idea of this panel is basically to overview what we've seen. And many of us, I think all of us on this panel, have learned a lot. And again, in the percentage increase in knowledge, it's been enormous because the base was really fairly low. I've been coming to Saudi Arabia for 4 years now. I thought I had well, I never thought, but I had some knowledge of Islamic finance, so I'm a bit farther down the learning curve than most of my colleagues, but I'm still a novice. So we've learned a great deal. And what we're going to try to do is reflect in this panel on what we've learned. And the way we'll do this, first I'll introduce all five in a very distinguished panel that you have here. This is three of the top journals are represented. There's 5 stellar academics, and I'll introduce them in turn. We'll start talking about a little bit, first off, about their journals themselves, just what kind of research they publish. Most are general finance, but some of them have a special focus. Journal of Corporate Finance, of course, has a special focus. A little bit about the publication details. And again, it's not to frighten you, but as a reality check, the acceptance rate at the journals that you see up here is single digit in most cases. It's quite low. It can be done, but it's quite low. And to nail home just how difficult it is, and it doesn't get any easier. One of the things, I travel a great deal, and one of the ideas, one of the issues that keeps coming up is, you're an American, is it inside baseball, is it a rigged game? And what I have to tell them is no, I've been rejected by more journals than by far more than I've been accepted. It's hard for everybody. So we'll first introduce the panel. They'll talk a little bit about the journals themselves and a little overview of what they've published. Then what I've asked them to do is to reflect on what we've seen presented at this conference and some of the papers that have been published in recent years in their journal that would be a reference or typical, the kind of thing that would be published or might be published. Some of the themes that they may have seen that look like they would be promising. The risk and return in Islamic investing, which is a paper we saw here. Sukuk bonds. It strikes me this has always been, from my limited knowledge of Islamic finance, these are capital market instruments. These have passed a market test. So, and they're very, anything that has 9 digits after it in terms of hundreds of billions of dollars is inherently interesting. So, some of those. Some of the contracting issues that have come up in structuring, financing, how do the ijara differ from leasing, issues like that. Then we'll talk at the end about one of the things that clearly it came to me yesterday and listening today as well. You guys have created, the Islamic scholars have created some amazing databases. And one of the things that you can do, and this is what has happened through all of empirical finance, started out just US data, and then basically as more databases, data stream by the databases came about, you had the international capital structure and dividend studies, you had multinational access to data. So this is one of the things that we'll conclude with questions on, or how we might use some of the databases to answer questions that we can't do with our current conventional data sets. Comparative corporate finance is another way to look at that. At the end of that, we'll summarize and open it for questions, and we'll try to be done out of here by 5, so an hour and a half. So I'll start out by introducing the panelists, and I guess I'll start from my left. Professor Stephen Angina from the University of Zurich. He is an associate editor of the Journal of Finance. To my immediate left is Michael Falkender, the University of Maryland, also an associate editor of the Journal of Finance. To my right, Jared Harford from the University of Washington, editor, maybe managing editor of Journal of Corporate Financial and Quantitative Analysis. Our keynote speaker and god of finance, Professor Franklin Allen, is the formerly of Wharton, now of Imperial College, and managing editor of the Review of Finance. That's how I do refer to you, Franklin. You do know that. So, and then finally, a colleague, an old friend, a very old is probably not the right. A distinguished friend. Okay, well, I'll shut up while I'm ahead. Professor Annette Poulsen, my colleague at the University of Georgia when we both became rookie professors many, many years ago, who is the managing editor of the Journal of Corporate Finance. So I'll go ahead and start with Stephen, and if you tell us a little bit, or Stephen and Mike tell us a little bit about the Journal of Finance and some of the frightening details.
Yeah, so maybe I was going to reflect a little bit on what I, as an associate editor, have to do at the Journal of Finance, and just to make very clear, I mean, to some extent, given that I'm one of many associate editors, clearly, and also given that there's a team of managing editors, Ken, Michael, and Bruno, don't misperceive my words as sort of fully reflecting what the Journal of Finance thinks. That's their prerogative. But let me sort of try to reflect a little bit on what the Journal of Finance is looking for, and a little bit more narrowly from my perspective, what I'm doing as an associate editor. So basically, what is happening internally is that there's a process by which the managing editor team is assigning papers to a number of associate editors and referees, depending on the paper, and can be varying from, say, 1 to 3. And then all of these people are going to provide their opinions on whether or not the paper that is being considered is going to advance the literature. And that's a very high hurdle to meet, because obviously the literature is very, very big. And so now before that, there's of course some sort of pre-screening whereby the editors themselves are going to make a judgment call on whether or not it's necessary to involve all of these people. I think what is fair to say is that it's hard to make a substantial contribution to the literature, and the Journal of Finance, among other journals, wants to sort of have that as a bar. I think in terms of acceptance rates, we're looking at indeed 6%. But then is that conditional on desk checks, or is that?
That's all, no. So that's amongst all
submissions.
Okay. I've got the numbers.
Oh, okay, very good. So then I should stop talking, actually. Let's turn to the numbers. But so I think I can just echo what was already being said. It's really tough to make it into those journals. It's a lot of hard work and a lot of rejection letters. So maybe you should turn to the numbers.
So getting to the numbers, in recent years, approximately 1,200 first-time manuscripts were submitted to the Journal of Finance. And in the same one-year time period, we would publish around 70. Mm-hmm. So that is an acceptance rate through the entire process of about 6%. As Stephen said, the process is that it's reviewed by an editor, then it's reviewed by an associate editor, and then it goes to at least one referee. And to build upon what Stephen already mentioned, the first order question that I ask as an associate editor is, why does this paper have the potential to change the way that I think about finance? If it's a very narrow question and it does not relate to the larger first order issues in finance, it may very well be well done and rigorous and deserve publication somewhere, but that somewhere is not the Journal of Finance. And so I think it'll come out more in this discussion. I think it hopefully came out in my discussion of the paper I discussed earlier today, but the extent to which authors can think about not narrowly what's going on in the specific situation that they're looking at, but why does that particular situation inform us about the much larger issues in finance? What big picture question and conversation in the literature is moved forward by this particular study or this particular model or this particular set of data analysis? that linkage is necessary. If you don't make that linkage in the paper, in the introduction, it often won't even make its way to a referee.
Thanks. First, just a few of the facts. So the JFQA, the Journal of Financial and Quantitative Analysis, gets around 700 to 750 submissions a year. Our acceptance rate, fluctuates year to year, but it's around 7 or 8%. So again, it's hard to get in. I guess a lot of what Mike said sounds exactly what I was thinking, which is that there are lots of papers that are quite well done, good. They include things we should know, but they aren't big picture enough to be published in a top general interest journal, meaning that basically if it's a general interest journal, it should be a big enough deal that no matter where your particular sub area is in finance, you should still find this outcome interesting or this paper interesting. And so a lot of it is in what's the motivation for looking at this particular research question. It shouldn't be just this hasn't been looked at before, or we don't know this particular fact. It should be what are we learning about some a major theme in finance that maybe you can learn in, for example, in the context of Islamic finance, or you can learn in the context of some of the institutions that are different than they are elsewhere, and tying it to that, I think, is a much more successful strategy and a much better way of motivating the research question that you're investigating. And you could see it in if you look at the two papers that won the awards, that they were framed in terms of bigger picture issues of moral persuasion, or the bigger picture issue of how do you design a contract, how does a profit sharing contract arise endogenously, and how do you motivate wisdom of the crowds. And they have clear, one of them was done in the setting of an Islamic credit card, and another one had a clear application to understanding what makes, why does Islamic finance make sense? Why do these particular profit sharing arrangements make sense? But that wasn't sort of their reason for being. Their reason for being was a bigger picture issue, and they were done either in an Islamic setting or had a clear application to Islamic finance. And I think that kind of motivation and that kind of framing of your question is the kind that's going to resonate with a broad audience of readers, and it's going to be the kind of framing that creates a paper that has more impact and is therefore more attractive to a top journal. But I'll let Franklin talk for a little.
So I'm the managing editor of the Review of Finance, which is the journal for the European Finance Association. We get at the moment, around 800 manuscripts a year. We publish about 50 to 60 papers a year, so it's the same kinds of numbers as JFQA, roughly speaking. Bill used the word rigged and said it's not rigged. I agree with that, it's not rigged, but there is a bias. And one interesting question is, what's the evidence for that? Well, Andrew Caroli, who's the managing editor of the Review of Financial Studies, which is one of the very best journals, has written a very interesting paper called Academic Home Bias. This is a paper that we've accepted and we're going to publish. Now, what he did was to go back over the last 20, 25 years and look at where papers were focused to the extent you could identify them being associated with a country. And he looked at the top four, which is the JF, JFE, RFS, and JFQA. And what he finds is that 84% are based on the US. So 16% covers the rest of the world. That's China, which is now the largest economy by PPP terms. It's India, which will soon be the largest population. It's the whole of Europe. It's the Middle East. It's Africa. It's South America. So 16% goes for the rest of the world at the moment. So it's incredibly difficult to get a paper published. Now, when you say bias, what is the sense of the bias? Well, he also did citation counts. And the 16% that are non-US papers have a higher citation count than the 84% that aren't US, which suggests that it's more difficult if you're not from the US. And I think that's true. I think that, you know, that Andrew did a very careful job on this, and I think one of his aims is to change that. And it's certainly one of our aims at the Review of Finance to try and change that. We have accepted, as Bill mentioned, an Islamic finance paper. Stephen was the editor before he switched to the Journal of Finance, so he handled it, and next time he speaks he can perhaps give the details of that. We get a fair number of Islamic finance papers. I think actually Stephen started a trend and solicited a number, and so we are very interested in that. One of the things that I found very frustrating over the years that I've been traveling a lot is that when you go to Asia or you go to Europe, you spend a great deal of time listening to papers about the US in the seminars. And this is because many schools around the world have imposed a limit that you have to have 3 A's or 4 A's to get tenure. And this is problematic in my view because of this problem that there is this bias towards US finance. But nevertheless, it's there. I've had co-authors who've tried to get around that, and in the end, it's hurt them. So, you know, my own recommendation to you is to do a portfolio of research. Try and do research on the areas that interest you, both in the location where you want to live and contribute to, but also do work on the US. And I think it's very good. A lot of universities now pay for their faculty to spend a few months of the year in the US at very good universities. And that's a way to learn how to publish in top journals. Work with co-authors who publish regularly. And then once you understand what kind of standards are imposed, then it's much easier, I believe, to publish non-US papers. And ultimately, that's very important. Everything we've heard about at this conference in terms of Islamic finance is a very critical area, particularly for this part of the world. We need to have papers so that people understand it. We need to have it in books and so on. And so it's going to take a long time, though. As I say, you can see from these kinds of rejection rates that it's very difficult. It takes years to do it. Don't get discouraged when you get rejected. We all get rejected all the time. It's very frustrating. My own thing is to put it in a drawer for a month, then when the emotions have gone down, to look at it again and start out. So, but stick with it. That's the main thing.
I'm the one of the editors of the Journal of Corporate Finance. Jeff Netter is the managing editor, and then there are 3 of us who are co-editors. We're all at the University of Georgia. We're all in the same hallway, so we do a lot of joint work. Jeff Netter is my husband also, so I do tell him a lot of what to do also. And he listens, yes. But we've been doing it for a long, long time because I'm very old. We've been editing the journal for about 10 years, and it's really been very instructive to see how corporate finance has changed over that time period. We are, in contrast to the other journals that have been talked about where they are more general journals, we are focused on corporate finance. So a lot of the material today and yesterday, not quite in that area, but it leads me to think about what are some of the corporate finance issues that could be addressed in addition to some of the financial intermediation discussions. And I really enjoyed Rawan's paper, for example, talking about capital structure issues and how they come into play in Islamic finance. To reiterate the idea of we get a lot of papers, we reject a lot of papers, we're also below the 10% acceptance rate. We probably get about 500 papers a year. We very often get, I feel that we are the first round after a paper is rejected by the big boys, you know, because it very often is that they get the letter that says this is very interesting, but it is not general enough for our general journal, and the paper is sent to the Journal of Corporate Finance. So we think we have a very significant role to play there. But to go back to the idea of rejection, what has become increasingly common in the journals is the desk reject. And this is really to think about what is going on, that editors are getting so many papers, and refereeing is a very scarce resource. So what you want to do is make sure that you get to the referee, and that goes back to the things that Mike and Jared talked about, that you have to get your paper in great form so that when it hits the editor's desk, it is pow, this is something they want to read, they want to have the possibility of having it in their journal, that you have the interesting question, that it is something that's big enough to attract interest, that you have worked that question into the existing literature, and that you are clearly cognizant of how your discussion fits into that story, and that you make the case that this is a significant contribution. We want to see, does it add to the existing knowledge? Is it something that is significantly different? We do publish a lot of international papers, and what we are very leery of publishing is a paper that just replicates what's been done in the United States for Singapore. Well, we want to know, why is it interesting? Not just that, gee, Singapore is the same or Singapore is different, but what is it that makes this an interesting question? What are the details about Singapore? What are the details about Islamic finance that make your paper especially interesting and adds to our knowledge? So that's very important to us. And then the last thing is just, does your paper show care? Have you taken care of your work? Have you presented it in a way that is clear, well-written, well-copy edited, that you have presented your work at a very high level for the audience that you are aiming at? It needs to pop off the desk. It needs to be, this is a paper we want to pursue. And I guess I'll leave it there.
Thank you very much. This is helpful. Let me throw this in as a pure consumer. Quite rationally, no journal has ever asked me to be an editor, which is a very good idea. So I've not done that. I'm purely kind of parasitical. I'm a consumer. But let me give you that perspective. What you try for, as when you're submitting to a journal, papers are never, even giving these odds, they are never accepted first round. So the best you can hope for as an author submitting to a journal is a revise and resubmit. Most of the time you don't get that. So you're trying to get it so it's not first desk rejected, to rejected by a reviewer, and then rejected by the editor. If you do get a revise and resubmit, this is really important, particularly for junior faculty or students. Many of these are actually reject and resubmit. In other words, if it doesn't say drop dead and go away, you have a chance to send it back. I've always approached anytime you get a revise and resubmit, this is when it becomes rational to invest 600 to 1,000 hours if that's what it takes. Now you have, what you want to do when you send a paper back is generate a positive abnormal return. When you send that back, you want it to be better than they expect. So one of the things that, if you do get a revise and resubmit, you basically put as much time as you can into it. Particularly if you're starting out, your first paper, or especially your first A paper, it may be the highlight of your career, may get you tenure, but it will definitely be a professional milestone. So you want to do whatever it takes ethically to get that. I sometimes ask, what would you pay, or what would governments pay if you could buy a Journal of Finance article. You know, think that one through. It would be tens of thousands of dollars. Do what? Higher. I'm sure you're probably right. There are many countries that give bonuses, cash bonuses, to faculty who can publish in top journals, and they're very rarely claimed. It's very hard to do. I visited the Duke for a term, and when Cam Harvey was the editor of the Journal of Finance, and he said something that's resonated with me for 10 years, is that one of the first things he looks at when a paper comes, these thousands of papers that come in the door, is, especially if he doesn't know this person or doesn't know them well, is to look at the acknowledgement footnote, which struck me as, why in the world would you do that? But of course, the logic is completely sound. What are you looking for as an editor? And again, you guys correct me if I'm out of school here. You're looking, has this paper been polished? Has it been presented around at top conferences and good schools? Have the right people commented on it? Has it passed market tests to get on at top conferences? So certainly the papers that were presented here, hopefully you'll thank this conference, and hopefully that will provide some certification as you go forward. I'd also like to, I think we all said this, you have to be tough and you have to be resilient. Most of the answers you get is no. Now, when you send it to a journal, you send it to a top conference and it comes back, sorry, journal space is very limited. You know, have a bad day, cry if it helps, get up the next day and go back. You just have to be tough and you have to be resilient. And I've also, Franklin, what you mentioned is, and I've seen Andy present that paper around, in traveling, and all of us travel quite a bit internationally, I'm often struck by, you'll go to Europe or Asia or the Middle East, and you see students and faculty working on American research, and it always seems kind of odd. What is your comparative advantage? Why aren't you doing the local? But take his advice is very sound. We shouldn't have this bias, but it does exist. So let me then switch gears and go to the topics that of papers that have recently published in the stream that they might learn from. And before I turn it over to the distinguished panel, I had this, and in talking with all my colleagues here, a universal experience for Islamic finance is when we're Westerners and we start looking at it, we try to do it, we're trying to understand it from an American, or from a Western perspective. What is Islamic finance? Is it equity? Is it preferred stock? Is it debt? If it's not debt, what is it close to? Craig Lewis had a very good paper on very good discussion on maybe it's like a convertible debt or convertible claim or a warrant. So we bring this perspective. So if you're a writer of Islamic finance research, keep this in mind. Fair or not, it's going to be Western journal editors and reviewers are going to review your paper. Explain it to them in terms they can understand. So with that cautionary tale, Stephen?
Let me take the opportunity to sort of complement some of the things that were said, and in the light of sort of looking for topics that came also from this conference that would be potentially valuable for the very best journals. I think on the one hand, it's very true that it's necessary for the paper to have a sort of a big idea and a sort of an altering nature to it. Having said that, and now I'm maybe looking a little bit more closer to what I'm trying to work on, empirical banking. Right now also what needs to be under the hood of the car, so to speak, is at the same time a razor-sharp identification strategy and very high external validity in the sense that one wants, there's a lot of really big data sets that are being used currently that are also being matched left and right with many other data sets. So to that extent, it is also these nuts and bolts that are needed for the car to run, in addition to, of course, having sort of the ability to have this big idea. Now, having said that, and complementing what Franklin was saying, yes, there is this bias. I mean, having been outside of the US, trying to work from outside of the US, I have personally also noticed that, and many of my colleagues have. But having said that, there's definitely a trend in the good direction, so to speak. And if I again draw it closer to empirical banking, you will see now a lot of papers with data sets from Europe, from Asia, and also if you want in the profession, there's a trend for more inclusionary. If you look at the For example, the editorial board of the Journal of Finance, there are many more people from outside of the US on that. So I think to that extent, closer to topic, then I would say, well, Islamic banking, given that the conventional banking system went through a financial crisis, it seems like there's also more receptivity towards sort of coming up with ideas to somehow fix, to speak, those weaker parts, if there are any. I mean, to the extent that needs to be subject to research. But so there is definitely a receptivity out there that was maybe not there 10 years ago. And again, I'm talking more sort of on the banking area. Maybe this is not so relevant for those people working on markets. So I think to some extent, the wind should be in the sails of those outside of the US working on non-US data sets and on financial systems other than the US. Let me conclude.
You just tell them which paper you accepted and.
So in the review there was the Abedifar, Molineux, and I forgot the third co-author. Yes, I always mispronounce your last name. So he's sitting there actually. So this a paper on at the bank level on sort of differences, stability, profitability of the banks. So it's actually already in print, right? Oh, it's not. Oh, okay.
So, couple of things, just mostly responses or augmentations to things some other people have said. As Franklin mentioned, a lot of us travel abroad regularly, and we often get the question, is it a rigged game? And so I'm going to provide my perspective on that. And while, yes, there's a very high association between where some of us are at and the likelihood of publication, I'm one of those who does not think that's causal. Instead, what it reflects is that because we are in departments with lots of other highly successful scholars, because we travel to lots of conferences and have the opportunity to meet a lot of other academics, before I submit a paper to any journal, my acknowledgement section is rather long. Anytime I submit something to a journal, it's been vetted quite a bit. I think Jared has been my referee, I think, more than once. I certainly have been his. But even before I submit the paper, if it's anywhere related to something that Jared has done work on, I've already asked Jared what he thinks. Not because I'm trying to game the system, but because Jared is thoughtful about these issues and understanding how he thinks about these issues and getting a feel for what I might have missed or what additionally I can do. I'd rather find that out from Jared at a conference than find out when he rejects my paper. And so I can't underscore enough how important it is that before you send a paper, if you really think that your work has the opportunity to make an impact on the profession, I cannot underscore how important it is to present it at a number of places before you send it off to a journal. With respect to, okay, and then another item that came up is the issue of care. So Annette brought that up. You know, one of the things that I'm, in addition to where the paper fits in the literature, one of the things that I'm looking at is how well has the author explained what they're doing? Do I kind of buy the results because they have convinced me that they have engaged in their analysis rigorously? And I can tell you as an author, almost pretty much all of my papers have at some point been replicated. And the last thing you want as an author or as an editor is for somebody else to come write a paper that says, why did this journal ever publish this paper? Because its results are very suspect. You know, you have to cook the data in a very particular way in order to get the results that the author presents. That's not what you want as either an author or as an editor. And so that's one of the things that you're also looking for is have they demonstrated care? Have they explained fully why they have engaged in the process in which they've engaged? And finally, I want to address the issue of identification. I think I'm an officer in the identification police. But I want to explain what that means. You know, we have moved away from merely claiming correlation to trying to specify a particular economic channel at work when we engage in data analysis. And in order to generate identification of a causal link, one does have to refute other potential channels that might generate those same correlations. And so the razor-sharp identification is not being imposed as an unnecessary burden to differentiate authors. Instead, it is to identify the specific economic channel that work and to refute alternative economic channels and to really be able to claim that causation is at play. The standard that I operate under and that I have been told by the editors is have the authors done what's feasible with the data. If it's a brand new question that the literature has not looked at, it's new data that we've not maybe thought about before, then merely showcasing the data and making an important point with that data may be sufficient. But if you are looking at a question for the 7th time, or if the literature is, then you need to, in order to differentiate what you have done relative to what previous works previous correlations have shown, you need to establish causation. And so I'm feeling a little defensive simply because identification has been challenged. You know, why are we so tough on identification? And largely that is the reason. Finally, with respect to the question that Bill actually asked for this round, I would point to, again, picking up on what Franklin said, some of the recent papers that have been published in the Journal of Finance that look at non-US data. And one of the ones that comes to mind, for instance, is some of the work that Daniel Paravicini has done, which has been awarded the Brattle Prize, which is the best corporate finance paper in the Journal of Finance, where he uses data from South America. But again, much in line with what I commented on earlier, he was able to answer a question that we weren't previously able to answer because he had unique data. And so he did not frame, the mistake that I see all too often with international papers is the one that was described earlier. We're going to go look in Singapore for something that we've already looked at in the US and we're going to get the same result. No. We use international data to answer a first order question that we haven't previously been able to answer.
Okay, so I think, yeah, I'll start with the original question, which is about the types of papers, and then I'll add to some of the others' comments. So, you know, first of all, the JFQA is definitely open to papers that are in an international setting, also to papers that may be, you know, exploring issues of religion or different institutional details or culture. You know, in the past few years, just, you know, I can think of a few papers that fit this. We had a paper on religiosity and stock price crash risk. There was a paper about cultural norms and the funding of startups and so forth. And so, you know, we're very open to this. I was interested in some of the facts that Franklin cited from Andrew's paper. The bias about US data is clearly there. I think the good news is that the trend is heading in the right direction. Utpal Bhattacharya has his PhD students every year look at the papers from the top journals over the previous 5 years and look at various classifications of them. And he just sent me an email about 2 weeks ago saying that it's about 20% now international in the empirical papers in the top journals. And also he has a point there, which is that niche is not niche anymore in the sense that the journals, and this is my own feeling, are more open to, to papers on what had typically been niche topics like household finance and cultural issues. And I would draw parallels in terms of what papers on Islamic finance might be facing in terms of sort of breaking the ice. If you go back to the early 90s, behavioral finance was nascent. I mean, and it was actually facing sort of a hostile audience in terms of efficient markets. And also you look at the great strides that household finance has made just recently in making it into the journals. And so it will take a few papers framing the questions the right way, and then and also carefully explaining to the general audience what we've all spent the last 2 days learning about the interesting details that make up Islamic finance to kind of get the ball rolling. But I think there's a lot of potential there. I would definitely agree with everything that people have said in this sort of second round, especially about the vetting. That was something I think Bill, you led off with that. That was something that was even told to me almost 20 years ago as a PhD student. Is that one of the things that journal editors look at is have you at least asked a lot of people for comments and presented this paper around? Are you giving yourself the best bite at this apple before sending your paper off to be reviewed? And it's rational for all the reasons that Mike mentioned. It's rational in the sense that you do only get one bite at the apple at each journal, and so you want to have already reached substantial diminishing returns with asking everybody else for comments that you can get. And then yes, we all get rejected. It's not personal. It's not because you're not in the U.S. I agree with Frank on that. You do a month. I have a 72-hour rule, which is when I get a rejection, I completely ignore it for 72 hours so that I can read the comments with an objective, or at least closer to objective mindset. Because even in a rejection, there's information in that referee report about what you can do better. And we talked about persistence. My colleague John Karpoff likes to talk about what he calls the 10,000 day problem, which is that your career will easily span 10,000 days. A very good career would have 10 solid publications. A CV with 10 solid publications is a good career. It's enough to make full professor at most universities. And so what that means is that in 10,000 days, you'll have 10 days with good news in them. And so if you're not a very persistent person, this is going to be a tough career for you, because this is not a business where you get a lot of times with people sort of patting you on the back and telling you how amazing you are. Instead, most of the time, people are telling you what's wrong with what you've done, but they're telling it to you in the right way, because we all want to make, it's a very collaborative profession. We all want to make the work better. We all want to get to the right answer. And as long as you take it in that context, it's a lot easier to take. I'll turn it over to Franklin there.
I think it's important to realize that quite how the system works. So hopefully when you did this conference, many of you had the opportunity to read a lot of the papers and write mini referee reports on why they should or shouldn't be accepted. Try and jump at those kinds of opportunities, because it's very useful to be on the other side of the process and think, what was wrong with this? Why am I rejecting? Why is this one such a good one? And so on. So to the extent you can be involved in conferences and so forth, try and do that as much as possible. Submit to the top conferences. I mean, I guess the top ones would be the AFA, the WFA, the EFA, FIRS, which is the Financial Intermediation Research Society, and the FMAs of various kinds. So get involved. Try and go to these conferences as much as you can. Those of you who have administrative positions, make sure you provide funds for people to go. These are all very important parts of what we do. Make sure you know the other people, particularly Islamic finance is spread around the world. So you go to Malaysia, go to Indonesia, go to other places with large Islamic finance communities, so that you can build bridges and understand how people think about the issues.
And I will say, if Franklin takes a month to think about a rejection and Jared takes 72 hours, I'm not sure how long I take, but I'm pretty certain that sending an angry email to the editor immediately after you get your rejection is not the right thing to do. And I won't say whether or not I've done that. And adding on to the comment about being a referee and going to conferences, I think another way to improve your research is to very carefully analyze the papers that are in that same research question. How did they begin the paper? How did they think about motivating the paper? What can you learn about that motivation that you can parallel or develop in your own paper? How did they develop their hypotheses? How did they do their work? There's a body of work out there that we can all learn from, and I think it's incredibly important to see what has been done in the past. And not to say to mimic that, but to learn from that, because there are standards in the profession that we expect to see. And if you skip that motivation section, your referee and your editor are going to be looking sideways at this paper and trying to figure out what's going on. But just use the idea that you can learn from everything out there, whether it's refereeing, whether it's conferencing, or just analyzing those papers incredibly carefully. I think the idea that Upal's looking at what's been published for the last 5 years, having his PhD students do that, he's teaching the PhD students to think about what is the existing research? How can I figure out where my work is going to fit? I think that's a tremendous idea. Back to the original question, which I think we've pretty much ignored. Sorry, Bill. What we have done at the JCF, we have had several special issues on China, and that it sets a parallel for me for what could be done with the Islamic finance, that we have just an open call, papers on what's going on in China, whether it's corporate governance, whether it's mergers and acquisitions, whether it's privatization and state-owned enterprises, where Bill has done an incredible amount of work, market microstructure, profitability of firms, vertical integration, public-private decisions. All those things are exciting in a vibrant economy, and I see parallels in thinking about Islamic finance. But I think in order to do comparative research, there's kind of 3 areas that I think are really important to incorporate into that research. And we've seen all of it throughout these 2 days of conferencing. Importantly, we have to understand the country institutions, we have to understand things about the legal environment, we have to understand the rules and regulation, we have to know how this country interacts with the rest of the world. Those are important parts of a country comparative analysis. How do the markets work? What are the product markets like? What are the labor markets like? What are the financial markets like? How does that come into play? And then the firm specifics. What is going on in these firms? What is the governance structure? What is the typical governance structure in an Islamic firm? We haven't really talked about that these couple of days. What is a typical capital structure? How do firms make decisions? I think if we think about comparative country research and incorporating the country dynamics, the market dynamics, the firm dynamics, we can have a better picture. We go back to the LLSV research, how culture and how history affects growth and development. I think there's a great parallel there also for Islamic research.
We'll do one last bound, but let me have some responses listening to my colleagues here. I was going to mention the identification police, but this is very important. One of the other things, you look for natural experiments. Something that changed in a country, the tax law changed, Islamic finance was allowed or not allowed. So you look for natural experiments as a way for identification. Also was mentioned your colleagues. I think, Mike, you mentioned this, the importance of your colleagues bouncing it off people that you trust. That actually key to historical experience that Annette and I were in the same department for 12 years, and one of our colleagues on the paper that I was my most widely cited empirical study, actually, on the Journal of Finance on venture capital certification, and it was a colleague who actually came up with that idea, David Blackwell, we were struggling with what exactly is the hook that we would do with this data that we had. And he suggested, well, what you have is, you're talking about certification. And that basically not only gave us the title, but the framework in which to do the study. And he was always a great reviewer, and it was kind of his curse, because everybody sent him papers to comment on. Very briefly, one of the things that also came up here, when do you post on SSRN? We all know the drill, that this is something that 300,000 papers are there, over 200,000 authors have posted. I've changed completely on that, and this is, I used to, as soon as you had a working paper posted on SSRN to establish property rights. I no longer do that. I recently finally had 6 years, 6 rounds, a paper published in Review of Financial Studies in Sovereign Wealth Fund with my co-author, Velchko Fotak. We posted it early and very quickly had multiple competing authors with the same, sometimes I'll just leave it there. So now I don't post SSRN early, only until we're ready to send it to a journal. A couple of other things. Find your comparative advantage. And one of the things that's so hard about, particularly for junior faculty or students, to wait until you polish the paper to send it in, is you're in a hurry. You want to get it done. But delay, present, polish again, edit again, polish again, before you submit it to it. You only get one shot. And usually they won't say, it's too bad a tree had to die for this, but you can get fairly harsh reviews, and once you're rejected, you can't send it back. Co-authored work, most work is co-authored today. You look at the journal and see. Everything I do is co-authored. I have no comparative, I can't do any math or computers or anything else, so everything I do is co-authored. As Velchko knows very well. I can't resist this other thing about a conference. One of the things that we've been to conferences many, many times. I've been doing it for 30 years, a little bit more. What's always scared me about conferences was not actually presenting the paper, it was the social, going to the receptions. This is a social business. So when you go to these conferences and have your paperwork and your research presented, force yourself to go to the conference, for the reception, learn how to schmooze. It's not, connections don't get you published, but they do help with a lot of other things. So for the final round here, I'd like to ask, one general comments that you might have had, but also where you think some of the databases might fit in going forward.
You mean the local databases?
If you have general ideas, but I was thinking, some of the databases that we've seen created here, how do you think they might be used to answer some of the open questions of finance? It's hitting you hard.
I mean, maybe more generally, and echoing your point on the importance of that, it's really a collective business where knowledge is being created. To some extent, the fact that the vice governor of Sama was here at this very conference, I think would be very sort of indicative of leads on potentially seeking out data from an agency like Sama or similar type of institutions that do have an interest in further knowledge on this specific topic, and if they then understand that opening partly their vaults, which they typically have in terms of data, given their supervisory and other types of activities, and somehow connect that to academics on the outside, I think can be a very valuable and productive line. It's, of course, it takes time. I mean, one needs to build trust, one needs to set up the configurations, but I think it's potentially, at least sort of from a purely empirical point of view, a high yield strategy.
Mike?
What is the question?
The question is, general topics that have come up, or where you see some of the databases might be used to answer questions in finance?
Okay. In terms of general questions that have come up, I guess I want to reiterate that attending conferences is not just about presenting or discussing papers. More importantly, it is the coffee breaks and the social events. again, there have been plenty of conferences where I haven't had my paper on the program, but that has in no way kept me from soliciting comments from people. But also getting to know people at conferences who later become potentially co-authors, even if they also might become your referees or some other capacity. But it's often interesting to talk to PhD students because they don't realize until they get on the job market just what a small world the academic finance profession is, that we all know each other. We see each other at conferences a few times a year. And it is important to become part of that network. I don't want it to be called a club or a clique, but it is important to be part of that. In terms of the data and the opportunity for research, I guess I would first start with a lot of the banking papers that were done yesterday. You know, there's an ongoing, very important discussion about international capital standards and thinking about some of the variation in institutional details that you have in Islamic banks and Islamic countries. And again, how do those structures fit within the much larger discussion about international capital standards, I think is important, because we don't want the results of international capital standard negotiations to only be appropriate for Western banks. It needs to be homogenized across all different types of financial institutions. In terms of some of the corporate finance stuff that I saw this morning, again, just reiterating what I said in my discussion, it's how does the menu of contracts, if you will, that we observe in Islamic finance augment our understanding of the traditional contracts that we see. So how can we supplement some of our understandings with this richer menu of contracts that we observe and use the data to address those bigger picture questions would be my sets of advice.
I don't have a whole lot to add to what I said earlier and what has been said so far. I think that as a practical matter, studies that are trying to say banks perform better or stock portfolios perform better when they're Sharia compliant, they're going to have an uphill battle in the review process, just because we're all trained to view if you have a constraint and you don't have a constraint, the best you can do with a constraint is equal to the unconstrained world, and so the questions that get at another way of saying that is if it were optimal to be Sharia compliant, a conventional bank would just be Sharia compliant. There's nothing stopping them from being Sharia compliant, and so I think that some of the very interesting questions came out around the idea of systemic risk and the fact that conventional banks, while they may be performing optimally for themselves, they have no incentive to internalize the potential externalities that they're creating within the system. And the question of whether a system that follows the tenets of Islamic finance happens to create a more resilient banking system. I think that's a very legitimate and very, very interesting question. And as has been said, the questions surrounding how do some of these contracts that have arisen to remain compliant with the tenets of Islamic finance surrounding that, that we're sort of trying to do good. You're trying to you share risk, you share profits, you don't invest in things that are bad. How do contracts that are compliant with that, how do they help us understand, some of the outcomes that we see in the markets? How do they help us understand the menu of contracts in general? I think these are all very, very interesting, very legitimate questions, very fertile ground for moving forward in general questions of economics and finance.
Most of what we've talked about has been empirical work, but I think it's very important to stress that one of the things Islamic finance needs is a very good theoretical framework for thinking about things. And we saw some of the papers doing that. So we had the share contract papers and so on. I think these are very important. And if you do decide to take those, they're very important to go back and look very carefully at what's been done before in various literature. So the share contract is a particularly interesting one. So the Stiglitz 74 paper was cited a lot, but actually that literature goes back before that. There was a famous paper by Stephen Chung in '68, if I remember rightly. And that's a very old puzzle. And over the years, there's been a huge literature on that. So make sure you go back and check what's been done before and distinguish what you're doing that's different. But that's just one aspect. I think the leasing literature probably is something that is very important to understand, and how a lot of the Islamic finance work relative to the leasing literature and so on. But these institutional details are extremely important. And then the other literature would be the law and finance literature, which I think is very important. But don't just do empirical work, do theory too.
Well, I think I'm tooting the same horn here, but there clearly is a lot of interesting Islamic work to be done. Again, I come at it from the corporate governance or the corporate finance perspective, and I like what Mike said, that the richer contractual data sets help us augment our knowledge of corporate finance, and I think that's part of it. What are the contracts, and how are they different than contracts that may have been studied before? And I think it helps us to understand what is important in the existing contracts and what might just be historical artifacts in the existing contracts, and how Islamic finance is developing and accomplishing the same goals with different contracts, and how they intersect or don't intersect. I think that would be a very interesting area to pursue. Really, I walk away from this conference thinking there's a lot that I don't know. I mean, I've learned a lot, but I definitely learned that there's a lot that I don't know.
Yes, please go ahead, Mike.
I want to also supplement what Franklin just said. I've only ever written empirical papers, but too many PhD students and junior faculty think that they start doing empirical work, A, because the journals are more receptive to it, or B, because they're lower cost to entry because anybody can spin CompuStat tapes. I would say that the thing that frustrates me the most, both as a referee and as an editor, is the ad hoc nature sometimes of the empirical work that gets sent my way. And one of the things that I try to reinforce with my PhD students regularly is that you should be able to identify a theory that supports every regression that you run. This is not data mining. We are economists who are testing hypotheses that are generated by theory. I don't want you to bring me an empirical result and then try to backward engineer some hypothesis that explains it. You ran the regression because there was a theoretical contribution previously in the literature that caused you to structure your empirical test in the way that you did. I'm not saying that every paper needs a theoretical model, but every paper needs to have hypotheses that are supported by theory somewhere, and it's frustrating when that too many people do have these ad hoc specifications that have no theoretical underpinning, and so I just want to caution people against that.
Okay, our next step is for questions. As you're formulating your questions, let me just throw in a couple of other topics that came along. First I'd like to announce, happy to announce that we're going to do this again. There will be another, we're not sure exactly when, but there will be another Islamic Banking and Finance Conference. I'm very pleased that Professor Poulsen has agreed that it will be co-sponsored by the Journal of Corporate Finance. And she has asked me to be the guest editor and
Just said no.
Yeah, I know. I will do it. And, so for the next, put it on your calendar. It'll be sometime next year. We're not sure where, but and again, you can certainly send your papers from this conference to the journal, but next time it'll be co-sponsored by a very good journal.
Yeah, we're very excited about the possibility of doing this, and that it had, that was one of the reasons that I was so happy to accept Bill's invitation in the first place, and we look forward to having a special issue related to the conference. And I started out by saying we are the Journal of Corporate Finance, but we will not put that restriction on this special issue. It will be more Islamic finance in general. So, but we are very excited, and we hope that we see many of the same people here next year, and that we are successful.
And the last, a couple of other things I'll react, and then we'll open it up. One of the things that was mentioned about the working with your colleagues and going to conferences, the other thing that you should, especially young people and starting the career, your chance is recruiting. Don't forgo that. One of the beauties of academia is you get to pick your colleagues. Think about how often that happens. So as particularly for young people, young faculty, involve yourself as much as you're allowed, and if you do the work, you'll probably be allowed to become involved in the recruiting process. You get to know, though many of us, the best estimate, I've probably participated in 350 recruiting sessions over the years. Many of us have comparable number. So avail yourself of that. Positive economics, I jotted that. One of the things that as you know, the acceptance rate for this conference was well under 10%. And many of the ones that were not accepted were normative in nature. In other words, sure, Islamic finance is good, it should be done for this reason. It may feel good to say that, but research that we'll publish in good journals asks and answers a positive economic question. What does this do? What is the impact? And then you can draw the normative conclusions from that. The other that somebody mentioned earlier, and I'm surprised it hadn't come up more, is to incorporate agency cost in these studies, not only the empirical but also the theoretical studies. One of the things looking at the research from a Western perspective, we think that people are inherently, well, I wouldn't go quite so far as to say inherently cynical, but we think in terms of agency cost and strategic behavior, and yet they're absent from most of the models and most of the empirical work that we've seen today. The strategic behavior and the self-interest of agents. So with that, and last thing is you get in terms of co-author, particularly for junior people, when you're looking for a co-author, you're not looking for a clone of yourself. You're looking for somebody who brings you have a comparative advantage. You're looking for somebody who brings something that you lack. A portfolio. I'm so clueless in doing individual research, I actually tallied it up, and I've co-authored articles or books with 107 people, many of whom I've never even met. So most of the research today is co-authored. Find for somebody who is good, hardworking, brings a skill that you lack. So with that, we'll conclude it. Well, not conclude it, but it's open to questions. And if you have questions, please address it to a specific member of the panel. Or we'll pick it, and you get what you get. Yeah, Pradeep.
I don't have a question. It's more of a comment. It's more of a comment, and it's not related to Islamic finance. So first, I think on behalf of at least one of the three premier associations of our profession, I would like to thank the journals and the journal editors for doing such a fantastic job. Our 4 or 5 or 6 premier journals, and the editors and associate editors who do that. They put in a huge amount of selfless service, and for which I think, as a member of the profession, we should all be very grateful about. So that said, I just wanted to make a few few thoughts looking at the whole process. And one thing is that if you look at a typical, and it's nothing to do with Islamic finance or this conference in general, if you look at how our publication process works in finance, we typically take about 3 years or thereabouts for a paper to be published. And we have to ask ourselves, is there some way in which we certainly don't want to erode quality in any way? We have to keep the quality at the highest possible echelon. What is it that we can sort of step up look at it from the process from 10,000 feet, 20,000 feet, and see how else we can do it in order to be able to have same or higher quality, and yet make the process as faster, and not have just 10 nice days and 10,000 days or whatever. So from that perspective, the first thing we note is that the acceptance rate at each of the top journals is about 5–6%, and we all know that if one gets a rejection from one of the top journals, you repackage and maybe sit for a month and then decide how else you'll repackage this stuff and put it back again, and it will go back to one of the 4 or 5 top journals until you've really exhausted all of them. So therefore, if you look at it from that perspective, you look at the top journals, say 4 or 5 top journals as one echelon, you're looking at something like a 20% acceptance rate across the journals. And that is quite realistic, it's good. That would certainly, the remaining 80% don't deserve to be there, and that's fully acceptable. But the point is, the reason why the same article which had been rejected at one place, ultimately most of them find a place, is seldom for your first shot, the first journal shot to be accepted. So therefore, the process of one rejection, then you go through multiple, go to another journals, adds time to the process. And therefore, you have to ask yourself, is there some way in which we can make that process a little bit more, keep the standards and more friendly to the user audience? Now, I don't have any magic solution, and there can't be any magic solutions in there, and it's just a thought that I'm putting forward. Now, I've seen how the process works. My daughter's a law professor, so I've seen how the process works in law, for example. That's not perfect either. There are lots of negatives in that process as well. But what they do is that they have 2 times, they have a batch process. Instead of like continuous markets and batch markets, it's not a continuous market, it's a batch market. So all submissions take place twice a year. And you submit to all journals you want to at the same time. So you might submit, if there are 10 or 15 top journals, submit 10 or 15 top journals at the same time. And then the journals look at as what Michael called, look at the big picture, the introduction, what the paper is really adding on, and see, and then make offers to the authors. And then, of course, the authors then bid across, and you arrive at an equilibrium. Now, once a journal makes an offer to the author, that's not an offer to publish the paper in its current form. That's an offer to work with the author to take the process to completion. So essentially, it's like a first round R&R, but then you're basically saying, we'll work with you towards getting the paper in the form in which it ultimately is a quality which is good for the journal. Now, clearly, the idea of all journals in the reviewing process, is to bring the article to a quality which is outstanding, which is the highest quality we're looking for. So that's one way to proceed. And if we look at another way to proceed, a similar concept would be that we, in our current process, we have maybe 2 referees, 2 referee reports come. When the 2 referee reports come, the referee reports are God. There is absolutely no way in which you would you would not dare to say, look, this is a different other perspective here. Look, maybe you have not picked up on this. Look, there are things that you have not really, no, I want to say it, Bill. So don't say that, okay? No, I'm coming to it, okay? So there are other perspectives here. So how can we have a process where the associate editors or the and the referee work together with the author to say, this is what we think, and there is it's not anonymous. Let's forget about the idea that it's anonymous. Or papers have been published, have been presented in various places, it's not anonymous. So can work with the authors. So this multiple step that we have, where 20% papers get accepted, but over 4 or 5, it's not a question. I raised it right at the beginning, it's not a question. It's a comment. It's a big picture comment about how the, can we think of a journal process by which we can make this time limit shorter and yet keep the same level of quality?
So I looked it up. At the Journal of Finance, while it's exceedingly rare to have a paper accepted in its first submission, nearly half the papers are accepted in the second round. You know, conditional on being accepted, the manuscripts that are accepted, half of them are accepted in round 2, 95% of them are accepted by the conclusion of round 3. So, and our average turnaround time at the Journal of Finance is less than 60 days. So, one of the things that we have tried to do is, and the way that I approach refereeing is, if I offer the authors a first round revise and resubmit, I hold myself to the standard that I'm essentially contracting with the authors that says, if you satisfy me along these various dimensions, then that's going to lead to a successful outcome. I don't know if that's what you classify as partnering with them, but I would like to think that it is. The other thing is we have accelerated, as Annette pointed out earlier, we've accelerated desk rejections to try to get feedback to authors more quickly, and they are substantive desk rejections. It is not a form letter. You know, I, as an associate editor, write 4 paragraphs if I'm desk rejecting a paper. The final comment that I would make that is in line with you is I don't think that where we need to go after it is the refereeing process. I think it's the conference process. I do not understand why an AFA conference in January has a March 15th submission deadline. And so what that means is that if authors are gonna follow the advice that we've given that they should present at major conferences before they go through submissions, well, you have to have the paper conference ready in March that you're not gonna present until the following January, and what are you supposed to do in the interim? I think that's where in the polishing process, I think that there's slack.
Okay, first of all, thank you for this very informative session. I have very small questions. Doing empirical studies in Islamic finance is something, it's not an easy for data reasons. My question is, how can we, I don't know to whom I should address the question. I think it applies to all of the journal editors. But if you have very few data sets, like if you have 5, 10, 20 observations, how would you be able to make or sell probably the question you are asking is good, but the data is not helping you. How would you be able to sell the research to be published?
I think Stephen made a very interesting point at the beginning that if it's original research question, and we haven't been able to address that question before because it's a new environment, lack of data, whatever, I don't think the requirements of as huge and comprehensive and complete a data set is there. In many cases, I can think back to the first China corporate finance conference we did, which is probably 7 or 8 years ago. The research was nascent. It was, you know, it was very much small sample, very much in this region, this is what was happening, and I think there's a lot to be learned from what you might call case study type research. And then that leads to the interesting questions that then may lead to a larger database. The paper yesterday on field research, that might be something that becomes interesting to do, to actually go out to plants yourself or corporate headquarters yourself and collect data, talk to people. So I think We can generate the data, we can find the data. In many senses, we have become too dependent on these huge databases that give us 40,000 observations, and whoop, we run that correlation and hope the the identification police don't catch us and run for it. So I would be excited to see small sample research.
Just to amplify that, my first privatization paper published in the Journal of Finance had N of 60 and match paired t-test. Can you imagine that today? But it pays to be first on a topic. So any other questions? Yes, Martin, go ahead.
Yeah, so I think over the course of this conference we've seen two types of papers. So we've seen papers on Sukuks that align very closely with traditional corporate finance research. I think the second area in which we've seen some very interesting papers is more on the household finance side, and I think there's huge potential huge potential to do more on to better understand sort of the user side of Islamic finance. And as a matter of personal bias, I find that really interesting because it overlaps with questions of behavioral economics and so on and so forth. But so my question is that since household finance is not totally mainstream, or is not considered totally mainstream finance by many, and then doing that in conjunction with addressing a topic in Islamic finance, which is also not mainstream. So how much would you say, does that sort of like raise the bar or make it, how much harder does that make it to get a paper through the process? And sort of the same question applies for sort of non-traditional methods like, experiments and so on and so forth, in combination with Islamic finance, which is already kind of a niche field.
Okay. I'll leave that to one of the editors.
I guess I'll take a stab at it. At the end, it sort of sounded like, oh, hypothetically, say I have this experimental paper with Islamic finance and household finance. What's the intersection of that and publishability? No. I mean, perhaps I may be more open, to these household finance issues than others because my colleague Stefan Siegel does a lot of household finance, and I have a lot of respect for what he does, and I find it very interesting. And I think it's relatively easy to motivate because of the sort of welfare issues in getting some of these things right. So I think that, again, it comes back to the framing. If it's a household finance issue, and like your paper just happened to be convenient to do it in the context of an Islamic credit card, because you could send moral text messages to them, and they wouldn't say like, what the heck is going on here? Then I think that's a really neat setting to be able to do stuff. But I think you could probably still motivate this by saying, look, there's like 1 billion Muslims in the world, and so household finance that's specific to Islamic finance is still welfare important. And then just an aside on Pradeep's point earlier is that I think there is something to this idea that asymmetric written communication between the reviewer and asynchronous written communication between the reviewer and the author has certain inefficiencies built into it that I think are an anachronism, and it'll be interesting to see if we can move forward and start to use a technology which allows anonymity but synchronous communication could make these things efficient, because you do sometimes you're just talking across purposes, and it takes months to resolve the fact that you just didn't understand what the reviewer was saying, and so there are some efficiencies in the process that I think could be fixed.
Let me follow up next sheet. One of the follow-up for the Sukuks, because one of the things that has come up in side conversations throughout this is in Islamic finance, institutional details really matter. And one of the things about Sukuks that you look at, it looks like a bond to Western eyes, but then you learn some other things about it. One, there very few companies, relatively few companies, have issued both conventional bonds and Sukuks, which is what you really want. Very few companies that have done big Sukuk issues have done it twice. The British government has issued. Goldman Sachs has had a big Sukuk issue, and they got a low interest rate or a low profit rate for it, but they haven't done it again. It's a very complicated process. We have the world's leading expert in project finance, and Ben Esty, and much of his work shows that project finance looks good and has some real comparative advantages, but it is terribly hard to arrange, very contract intensive. And this is in many ways the same thing. They rarely trade. Once they're issued, they're held to maturity. So there's almost no liquidity for Sukuks. So there's institutional details matter. Yeah.
It's very interesting to hear that the top 4 journals have 6% acceptance rate. So does Harvard undergraduate admission. The reason I'm saying this, Professor Franklin Allen mentioned about the home bias, 84% America, 16% rest of the world. Is there also institutional bias? The reason I'm saying this, recently I've read a number of papers written by Harvard professors on Islamic finance, and using not data in the United States, like country like Pakistan, Turkey, in different parts, or generating data like Martin Kanj in Indonesia. What I'm trying to say is that in addition to institutional bias, I'm talking about, because for obvious reason, because these are the highly qualified, highly trained, they also control the journal publication process because they sit on their editorial board, editor, and so on. When it comes to Islamic finance, so we have to really cross 2 barriers to get to the top journals. The first, the institutional barrier. Not many of us, those who do Islamic finance, come from that institutional background. And secondly, Islamic finance is also something new. First thing that comes, the name Islam, the religion. What I'm trying to say as a journal editor and from your experience, I know you guys are more open-minded, but is there some sort of bias exist? The reason I'm saying this, I have a recent experience. I have submitted a paper in 4 journals. I'm not in this top 4, JBF. Finally, it was published in Journal of Business Ethics. It's a theory paper dealing with how you can really use the government guarantee in order to promote Islamic finance. So, interestingly, JMCBA, this editor rejected it on the basis of 1 referee report. By the way, it wasn't just rejected, and it was like sort of neutral, and he was very honest. And secondly, I found a month later, he sent me another referee report, and that was a little bit more positive, that at least it can be tried. So sometimes I feel that we have to, those who do Islamic finance are trying to, build this as an academic discipline, has to cross these 2 barricades. So can you suggest as journal editors and those, how we can overcome these 2 barriers, institutional as well as Islamic? Because is there some sort of allergy towards it? Sometimes I get the referee report in the area, it's a very good and this and that, but it doesn't fit with I'm not on desk rejection level, even the second level. So is there something you can share with us, or maybe some way you can help us, those who work in this area, that we can really move forward, get the encouragement? Because one thing really, the Islamic finance, forget about the Islamic name, but there is something, value addition, is good for everyone, for humanity, resharing those principles, fraud and all these things. Now, we can also bring this in a mathematical way, like Franklin said, develop mathematical model. But when it comes to empirical, the heavy duty, the data is very much non-transparent in Islamic world. Some way we have not produced the data. I'm talking about secondary data. Unless you sit in Harvard or World Bank or IMF, they have a lot of money, they can generate the data, can write the nice paper. I just want your opinion to share so that you can help those who are interested in doing Islamic finance research and take this as a field, is one of their vocation, to develop their academic standing in the community. Thank you.
Yeah, so I want to answer that because to some extent I may have partly sounded a little bit the bias card, and I also want to correct that because to some extent I think there's an enormous amount of built-in fairness and judgment into the system, and I think having, looking back over 25 years of being in the profession, I think that cannot be stressed enough, that there is really, and this is especially also for the young people in the room, there is an enormous amount of sort of professionalism in the profession in terms of judging the papers, the quality of the papers, the contribution, etc. So if there are these biases, it's potentially also partly due to the fact that some of the issues are played on a very marginal level. It's very competitive. I mean, at the very top, it's very thin, and so it's very difficult sometimes to make the right calls, and then some of the elements that were already put on the paper may make a difference in the sense of having received that golden comment from one of your esteemed colleagues to sort of nail the paper in a way that make it sail through. So I think, I always tell my PhDs that 95% of the game is fair, you should go for it. Yes, there's 5% where judgment and chaos is going to reign, but I think that shouldn't stop you from trying.
Pedigree matters, it always will, but it's not by any means end all.
I got a comment on Kabir's question. I had a paper on whether some of the Islamic injunctions would help in the securitization process. We know what happened in the subprime crisis when there was a liquidity freeze. Now, my personal thing is, whenever I look at, I work on, I'm a chaired professor in Islamic finance, but when I look at Islamic finance, I look at critically at the religious establishment in Islam. I mean, I'm very familiar with the scriptures, and sometimes I feel that the religious scholars literally interpret the injunctions, and I stay away from that. Now, my paper was sent to Journal of Corporate Finance, and there was one referee which was really harsh. Came down to 6 questions, but the editor was kind. He says, answer the 6 questions, the comments posed by the referee, and there is a possibility that you may get this thing. So I worked on it for 3 months, you know, and I got my piece in, you know. So the system is not completely rigged.
No, it's not.
As long as you do the work objectively, the system is not rigged, you know.
Well, that's a good, go ahead.
If I could just make a comment, this is what I like to use this quotation. I told him at breakfast this morning, and I think you illustrate this. Thomas Jefferson was one of the founders of the United States of America, and supposedly he said at some point that I find that the harder I work, the luckier I get. So that's your 5%, and if you work hard, it happens.
Yeah, I'll give it another quote for Hannibal is that an execution is good for morale. So I'm not sure exactly how that is. Thank you very much. Quick one? Okay. Yes, sir.
Well, this is maybe another dimension of publishing. You know, you publish in order to be cited. Now, the other challenge we are facing in Islamic economics and finance is the citation issue. I mean, or classifying choose how to classify your paper. We in economics usually use the GL, Journal of Economic Literature classification. But if you go there, you want to classify your paper, sometimes it's very difficult to find the number and whatever suitable for that. So just I want you to know about these also challenges. In fact, in Jeddah, in our university, King Abdulaziz University, we did finish with the classification system for economics, Islamic economics and finance, and in the process to market that and maybe make it available to everyone. Thank you.
Okay. Well, thank you very much. I'd like to very, very much thank my panel, and if we could. And we will close with the honored Dr. Sabel Abdul-Jawad, the Vice Rector of KFUPM, for closing remarks. Well, we can sit here, I guess. Yeah, sit here. More comfortable.
Bismillah, alhamdulillah, wa salatu wa salam ala rasulillah. Ladies and gentlemen, I'd like to start first of all by really thank you all actually for participating with us in this very important conference. Let me say that I am civil engineer, so actually maybe I have hard time a little bit to follow on some of the presentation that presented in this conference, but really I enjoy that all actually the part that attended. I enjoy very much the panel that we have yesterday as well actually we have this afternoon. And let me maybe start by giving some history actually about the experience of King Fahd University of Petroleum and Mineral in the area of Islamic banking and finance in particular. Almost around 4 years ago, the university established a Center of Research Excellence, Islamic Finance and Banking, and that actually is being supported by one of the family in our region, that is actually the organization of Abdurrahman Al-Rajhi. Since that time, actually, the center start actually doing some work, start actually doing a training program, and actually we start organizing some workshop in this area in particular. And what happened, actually, we did invite mainly the people that only involved in this subject, actually. The people they know, actually, Islamic finance and actually banking, they meet and discuss actually their issue and concern and actually the challenges that they are fast facing that compare with actually the traditional finance and banking. Well, actually, myself and KFUPM, when established Center of Research Excellence, would like actually to have identification. We have to have an impact worldwide actually in the subject that we select when establish actually a center. Then actually I told my colleague I'd like to see what happened worldwide actually in this subject. So I did go one time, attend one of the international meeting, and that meeting even is held at University of Harvard. That actually about Islamic finance. I found the same. I found all the people present in the conference, they are only the people that engage in that subject. Well, then actually the next step, I asked my colleague in the college and the center to do a kind of search to see what is the presence of Islamic banking and finance worldwide. And actually it was kind of a shock for us when we find almost, actually, when they look into the top journal in the subject and they found almost there is no presence. Maybe mention one or just few there, but actually we have in this session, but at overall there is no much presence. So that's why actually we plan for this conference. We plan for it to be a completely different than what been organized in this subject in the past. Maybe you have seen actually the group that participating with us. Hopefully with the help actually of the college, with the center, I should actually highlight the great effort by Bill in this regard. We managed to get actually 2 people from top institute worldwide, from academia, as well actually from industry. Maybe they didn't hear in the past about Islamic finance. Myself, I talked to some of the speaker and even some of the journal editor actually we have with us in this panel about if they hear in the past about Islamic finance. They told me they don't. So actually, and that's why actually our major objective in this actually meeting is to generate a kind of dialogue, is to generate actually a kind of communication in this subject, but actually most important is not going to end actually with the end of this conference. Yes, this is the last session and we are closing the conference, but there is a lot of work actually to be done. Bill already been highlighted. There will be a series actually of conferences will be organized by KFUPM in this subject. Hopefully, we're going to tell you soon about the time and the venue of the second conference. Great thank for Anit actually, for the Unit of Corporate Finance, actually for their offer to have a special issue actually for the paper that will be presented in this conference. As a matter of fact, this is going to put even more pressure on us, actually, on the quality of the paper that we are going actually to present to you, hopefully, in the second conference. Well, my colleague highlighted actually single digit, actually, for acceptance of paper in the top journal in finance. I should say we try our best in this conference as well. Now just 14 out of 170 paper. This is, again, is a single digit, is just about 8%. So try very much actually to emphasize on quality in this conference, but actually there is a lot of work need to be done. Actually, that's why actually I hope there will be a continuous discussion and dialogue actually till we meet in actually the next meeting. My colleague actually in the college and the center, they already prepare a special actually Islamic finance bulletin which shows the latest knowledge and information about the subject. I believe it's already part of the package that is being distributed to all. It is also available in the center website. This is going to be updated every 6 months. Actually, we'll give you additional information on the subject. I'd like to highlight also to continue the work in this subject till actually our next meeting. The Center of Research Excellence, Islamic Finance and Banking, they're going actually to sponsor a research project in this subject. So hopefully Dr. Abdullah and Dr. Muhammad, hopefully will give them one month period to prepare the highlight and the detail of actually of this grant, which hopefully we're going to communicate with you about its details soon, and hopefully we're going to see some of that work is going to be presented in the next meeting. Really, at the end, I'd like really to thank all our speakers that actually came actually long way to actually share with us their experience in this very important subject. I'd like to really great thanks to our actually journal editor, actually the scientific committee, the program committee for all actually remarkable effort they did actually for preparation and organizing this conference. Also, I'd like to appreciate actually the great effort by the member of the organizing committee for this conference, for great effort, but definitely you are actually the speaker, the audience is behind the great success of our meeting, and hopefully we'll see you soon in a year period or so. Thank you very much for participating.